Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 115th episode. Happy 2024. Today's guest is a returnee. Vandana Hari is the founder of Vanda Insights, a Singapore-based provider of intelligence on the global energy markets. She was with us in the early days of Kopi Time, back in April 2020 on episode 10. Those were the days when WTI futures were in negative territory. Vandana came back to Kopi Time in March 2022 on episode 72 when Russia's invasion of Ukraine was upending energy markets. Today, the energy markets also have no shortage of drama. Vandana Hari, welcome back to Kopi Time.
Thank you so much for having me back, Taimur. It's absolutely my pleasure. And thank you also for that very quick recap of our journey over the past 2 or 3 years. It's really interesting. We have yet another interesting episode now.
Absolutely. You and I have conversation both in terms of market exuberance as well as when the markets were in utter despair. And all that, as you said, in the span of just 3 or 4 years. So, Vandana, we're reconnecting. It's mid-January 2024, and the potential risks to energy supply have popped up again. So let's start with the very near term. Walk us through various scenarios over the Red Sea tensions that could affect the energy market.
Yeah, that's a good place to start, Taimur. It's absolutely the focal point of attention, well, not just for the oil markets, but in terms of news headlines, right, for the past several weeks. So let's take a look at the Red Sea and that region from an oil market perspective. So if you look at the Red Sea, it is the shortest route for connecting eastern US and Europe on the one hand, with the Middle East and Asia on the other. Now, the moment you take that into account, I think the picture becomes pretty clear, not just oil and gas, but even in terms of goods trade, that it's a vital shipping route. Now, as I mentioned, it's the shortest route. It's not the only option, but obviously taking the shortest route for any cargo, whether it's oil and gas, or any goods is obviously key, especially in the current climate of high inflation. Supply chains are easing, but still not as let's say normal as they were pre-COVID. So when you ask me about scenarios, I think that therein lies a major challenge for the oil market. So what we do know, so we know this is a vital artery. We know that the Red Sea saw about roughly a little over 8 million barrels per day of oil, both crude and refined products, transiting it in both directions. So from the areas, as I mentioned, from the west to the east and from the east to the west. This was until the Houthis began their attacks on merchant ships in the Red Sea around mid-November. So since then, obviously, a lot of ships have started to get diverted. Now, there's been an interesting divergence in that. Much bigger ratio of container ships, so those that carry containers and dry bulk and so on, have been diverted, close to 90% perhaps at this point. But for a long time after the attacks began, oil and gas tankers continued to transit. Important to keep in mind that there were no incidents. So incidents of major damage, certainly not any fire or certainly no casualties. So I think that was perhaps a factor. Now, so the market is contemplating right now, yes, maybe perhaps up to 10 to 20% of oil that would have passed through that artery is being diverted. It's having to take a much longer route via the Cape of Good Hope in southern Africa. Now, ballpark, that adds maybe like 14 to 10 days to 14 days to the journey. And obviously that has had a ripple effect, right? And we can talk a little more about that. But that is what the oil market can see today. That is what has been factored into prices today. Going back to the challenges, if we talk about scenarios, now obviously any disturbance, and this is much more than that, right, happens in the Middle East, the oil market participants have to start pricing in, to a certain degree at least, some of the worst case scenarios. And in this case, of course, it is that what if the Red Sea gets entirely shut to oil and gas traffic? Then yes, everything could still come via Cape of Good Hope, but you're then talking of a much tighter market in terms of tanker availability, much higher freight rates, and so on. Some of the much worse scenarios, of course, are a wider a contagion effect, if you will, in the Middle East, because of we're assuming that this Hamas conflict is going to fester for some time, unfortunately. So far we have seen great restraint from the Middle Eastern powers. What if the other countries in the region get dragged into it? And what if? So it's a lot of what if questions. Nothing that any of us in our lifetimes or even read in history books having unfolded like a wider conflagration. But that's the worst case scenario. But certainly, seeing where prices are today as we're talking, Brent around $78. What I can tell you is that is probably anywhere from $2 to $3 of risk premium, certainly nowhere near pricing in that worst case scenario of a quarter of the oil supply of the world comes from that region. What if that is disrupted? That's almost hard for anybody to imagine.
Right, Vandana. So super interesting to sort of think in terms of the worst case scenario and sort of build from that. And to your point, that it's not just about the scenario of oil not going through the Red Sea, but if there is a wider conflict, there are lots of oil refineries and oil fields in the region, and missiles can ignore boundaries and defense systems, and all you need is a couple of missiles in one refinery, and there could be a wholesale panic in the oil market. And also, the reality is that while no more than a quarter of the oil come from the region, the world has fragmented a bit. Russian oil does not go everywhere, or maybe it gets refined and goes somewhere and elsewhere. But things are far more fragmented than they were just a couple of years ago because of the Russia-Ukraine conflict. I'd like to ask you one technical question. So the interaction between shipping costs and energy prices, is there like a full and immediate pass-through? Because we have seen Shanghai freight rate or world freight composite and those sort of indicators, they were at basically pre-pandemic lows, extremely low levels in December. And since then, they have doubled. But even that is not particularly high by the sort of spikes we saw during the pandemic. But even this doubling of freight rates, what does it mean for spot and futures energy price action?
Yeah, so higher freight rates does mean higher shipping costs. So if you're a refiner, then your input cost of crude is going up, and either your margin will be squeezed or you will try and pass through those costs to your end user, which means you see higher prices of fuel prices at the pump. Now, what's happening? A couple of things. A reason we are not seeing this immediate pass through of the high freight costs that you're probably reading every day in the news is that, first of all, there's going to be a bit of a lag effect. So typically, if you're looking at a refiner, they get the crude into their refinery. It takes a few weeks to a couple of months until that crude is transformed into refined product and hits the market, or basically at your fuel pump. In some parts, especially here, if we're looking at Asia, it's not always easy for refiners to pass through all of the increased costs. So they may take some of the hit, and then the other is a lag effect. So you probably not see that sort of crunch time until a few weeks down the line. You mentioned, when we talk about benchmark crude futures. Now, so let's say we're talking about Brent, WTI, or Dubai, all of those prices that, let's say what you're seeing on the screen, or you're are being talked about in the market are free on board prices. So they do not include shipping charges or freight costs or insurance costs for that matter. So that's also a reason for a bit of a lack of transparency. So while you can see what Brent is doing, you can't always see what the landed cost of the refiner is doing.
I see. And I remember years ago, I think this was long before you and I showed up in our podcast platform. I think 10 years ago, there was all this discussion of the oil markets being in contango and backwardation and the relationship between sort of the spot and the futures. So how would you characterize the relationship between spot and futures right now in the oil market?
Yeah, so the two have to be absolutely connected. The connection or comparison that is more often discussed is between the so-called physical market, where buyers and sellers are actually bidding and offering physical crude barrels, and the futures market. So futures then most often than not, they are financially settled instruments, and you can buy as little as just 1,000 barrels of a contract, WTI or Brent, and so on. The two are definitely connected at the hip. They have to move in tandem. What we are seeing right now in the futures, let's say the forward curve, you mentioned contango and backwardation. WTI, the US benchmark crude, is in a contango, which reflects the fact that there is plenty of supply, immediate supply in the prompt market. Brent is in a little bit of, but very mild backwardation, which again tells you that there is plenty of supply in the market. And that is exactly what is being reflected in the physical market as well. So in the physical market, for instance, something that a lot of attention is paid to is these official selling prices from the Middle Eastern producers that are announced on a monthly basis. And a major talking point a few days ago was when Saudi Aramco, which sort of sets the stage for, what's the mood in the market, and especially amongst the Middle Eastern producers and exporters. It slashed in a big way the differential that it charges to customers in Asia and actually around the world for February loading cargoes. So there's plenty of anecdotal evidence, whether you're talking about the physical markets or the futures markets, that there is plenty full of supply, and perhaps a view that demand is going to be sluggish this year.
That's right. So I want to talk a little more on the issue of supply and demand momentarily. But before that, let's stick with geopolitics a little longer. So we talked a little bit about the Middle East, but then there's the whole Russia-Ukraine conflict and its energy demand dimensions. So, you and I last time talked about the Ukraine conflict when there was tremendous uncertainty about where would Europe get its gas, where would Europe get its oil, who can Russia sell to, and can there be a cap? So let's sort of walk through the last 2 years with respect to Russian oil and Russian energy and gas, and how that has sort of impacted the global landscape.
Yeah, a great question, Timur. And what a difference 2 years makes. And actually, it's been less than 2 years, right? Since Russia was cornered, found itself in a corner as a result of sanctions, as a result of embargoes, whereby Europe and the G7 countries said that we are going to phase out, and with the purchases of Russian oil, with the view of completely ending it, which is exactly what they've done. So in December 2022, Europe completely halted all seaborne imports of Russian crude. Europe was the biggest market for Russia. Russia was the biggest supplier for Europe. So here we're talking about a major shift in trade routes and trade patterns, the likes of which we haven't seen. And then in February of last year, Europe completely halted all seaborne refined product imports from Russia. And, when this whole thing started, so we're talking about the early months of 2022 after the Ukraine invasion, there was a great deal of fear that, because let's face it, nobody had seen a country of the size of a producer of the size of Russia, an exporter of the size of Russia, being slapped with sanctions and embargoes. So we had the experience of embargoes and sanctions, rather U.S. sanctions against Venezuela, Iran. Much smaller producers and exporters compared with Russia. So there was a lot of fear, and as it turned out, that fear turned out to be completely unfounded, and thank God for that, because some people were contemplating Armageddon in the oil markets. If you're talking about like
It's
Russia.
$200 forecast.
Yes, yes, indeed, which was understandable. And again, this is like talking. This was the worst case scenario again, which is very hard to contemplate, very hard to price in. As a result of which, people were sort of like putting a number in the air that who knows, we could see 200. Well, thank God, as I said, none of that happened, and this is testimony to the remarkable resilience of the global oil markets, the fungibility, the interconnectivity, the resilience of supply chains in a way as well, that all of that Russian crude and refined products, which got locked out of Europe, have been very smoothly, I would say, relatively smoothly. Yes, it's caused some tightness in the tanker market and so on, but relatively smoothly for such a big operation have been rewired. So what we see is like close to 4 million barrels per day of Russian seaborne crude exports. And I'm stressing on seaborne because there's some pipeline crude that continues to flow from Russia into Europe, and certainly flows into China as well. And seaborne exports, about 3.5 million barrels per day of refined products exports, have all found homes outside Europe. So China and India have stepped up. India has actually stepped in to buy used to buy next to zero Russian crude pre-Ukraine. So China and India are lapping up the vast majority of Russian crude. Its refined products have been rerouted into markets like Brazil. Brazil has become a major importer of Russian diesel. Brazil used to depend quite a bit on the US for diesel. So you see, you can just picture all the rewiring that's gone on, right? And it's quite massive. So US used to export diesel to Brazil, some of which has obviously been edged out by Russia. So US has been exporting more diesel to Europe in turn. Russian refined products have also made inroads into parts of Africa and even actually in the Middle East. So all of this has happened. Basically, the dust has settled on this, Timur. So as we stand today, and even through 2023, what may happen as a result of Western sanctions and even price cap on Russia, and the fears and the apprehensions related to that are all in the rearview mirror.
But Vandana, I remember in that summer of 2022, there were all these oil bulls who were saying global refining capacity is at a stretch because there hasn't been that much capex. U.S. Shale producers were telling the Congress, don't force us to make pledges about increasing production. We can because we don't have enough labor, we don't have enough equipment, there's not enough rigs, et cetera, et cetera. So how did the industry get that, so to speak, wrong? And then within 6 months, we saw supply side start to revive in a pretty dramatic manner.
Yeah, so I wouldn't say the numbers weren't wrong. They had a point. Those who were expressing concern that perhaps global refining capacity was not adequate did have a point, because we saw quite a dramatic acceleration in the shutdown, permanent mothballing of refining capacity across the globe, of course, mostly in smaller, less profitable, low complexity refineries around the world. It was a phenomenon pre-COVID. It was accelerated after COVID. So between 2019 to, let's say, to end 2022 or so, we saw about 4.4 million barrels per day of global refining capacity permanently shut. So that was a substantial number. What has and the period that you're talking about was there were periods of crunch time, phases of crunch time, I would say, through 22 and 23, when this rewiring of product flows was going on. And mind you, Russia is a major exporter of diesel. So diesel was the sort of focal point of these worries. Nearly 1 million barrels per day of diesel is exported by Russia. And as you know, before this rewiring was complete, there was concern, obviously, in Europe that, would there be enough diesel available in Europe? And to some extent, it was also linked to Europe's fears over adequate gas supply. So we do know that Europe has also lost, since 2022, a big chunk of pipeline gas supply from Russia. And when in periods of distress, when gas prices are too high, there's not enough supply, diesel is a product that is the product of choice for switching. So all of this created a sort of a perfect storm around diesel, if you will. And that's what links to this concern. Now, quite a distinct phenomenon that is equally worth noting when we talk about the refining capacity globally is that we are now in a wave of major growth in refining capacity, and thank God for that. So between roughly 2023 and 2027, so some of this capacity that I'm talking about yet has to come on stream, but between these years, we have nearly the same amount, so about 4.3 million barrels per day of new refining capacity coming on stream. So I would say that for the foreseeable future, refining capacity shortage is not going to be a major problem. Another shift that has happened with this is, as I mentioned, it's the less profitable, less efficient, older, simpler refineries that shut down. And what is coming on stream in countries like China, a lot of it in the Middle East, Nigeria, a major refinery starting up there, in Mexico, the Dos Bocas refinery, is all of these refineries are closer to the demand centers. And I think I should have mentioned it in the reverse order, is that they are much bigger. So they're mega refineries, they have economies of scale, they are higher complexity, and they're closer to the demand centers. In the case of Middle East, they're close to the production center of the feedstock as well. So all of them are going to be, definitely far more effective, more efficient. And I think going forward, I would say with the short to medium term, I don't see a problem on that account. Possibly, if we had to look beyond the next, let's say, 5 years into next decade even, there is a view that this current wave of capacity is probably the last wave we are seeing. So if oil demand globally continues to remain robust, if not rise, and not follow the sort of extreme decline that some forecasters are talking about, then we may be in a period of not enough refining capacity again, potentially sometime in the next decade.
Okay. Vandana, the rewiring story, I find just so fascinating. And we have two very large energy importers, India and China. How have their energy import orientation switched toward Russia than the Middle East over the last 2 years?
So China was always a major customer for Russia. In fact, in the years just before COVID and possibly just after that as well, Russia and Saudi Arabia had been neck and neck in terms of being number one and number two supplier of crude to China. And Russia had actually overtaken Saudi Arabia in a few years. So China has, as I mentioned, a pipeline. So there's about 800,000 barrels per day of crude that it gets from Russia, that is not subject to the spot market or the vagaries of pricing and shipping and so on. And China also takes a lot of seaborne crude imports from Russia. India, as I mentioned earlier, was taking zero crude from Russia and started lapping up now and very quickly ramped up the volumes it was taking as well. Now, both of these countries are price sensitive, of course, and if they were being offered discounted crude at times, Russian crude was going at a discount of as much as $25 a barrel, which, given those prices, it was almost 25% discount, was a great deal for refiners in those two countries. So if you look at 2023, India and China have together bought an average of about 3.8 million barrels per day of Russian crude, which is up almost 65%. But a big chunk of this growth has actually been India. So Indian crude imports in 23 were up 165% over 2022. So 2022, it had just made a beginning and it was ramping up. What the numbers illustrate is that ramp up continued pretty much through 2023. It was only towards the end of 2023 that when Russian crude became a bit pricier, the discount started narrowing, that we actually saw Indian imports from Russia starting to decline a little bit. So again, that also tells you that India will buy happily from Russia. It's not concerned about sanctions, and well, there are no sanctions against India buying Russian crude. Let's be very clear about that. But it will continue buying, but as long as it makes sense economically. So this is not a political decision; it's a completely commercial decision for India.
Speaking of commercial decisions, is it also the case that India has become a very large exporter of refined petroleum goods to Europe? Basically, to your point, huge import of Russian crude, and then it actually ends up in Europe.
And thanks for asking that question, Timur. This issue has been heavily politicized. It's got overblown a bit. So yes, India has a marginal surplus refining capacity. But what I mean by that is that, it's got a huge growing captive market at home, right? So pretty much its refining capacity is spoken for in terms of domestic fuel sales. Contrasted with China, for instance, which has way more surplus capacity. So if China consumes, let's say, 15 million barrels per day, its current refining capacity is around more than 18 million barrels per day, growing as we speak, new refineries being put on stream. So India is not quite on that scale. And so, yes, the refiners had a little bit of room. It's mostly the two private refiners in the country, Reliance Industries and Nayara. The state refiners pretty much cater to the domestic market. So, yes, Indian exports of refined products to Europe and to some other parts of the world also went up a little bit last year. But really, at the end of the day, India has very little scope to increase, because first and foremost, and the government will make sure that the domestic market is well supplied before any surplus is exported externally.
Vandana, what about fundamentals-based demand? So before this Red Sea issue became prominent, I'm sure you were busy writing your 2024 outlook and you were assessing demand around the world. From my sort of economics vantage point, I don't really see that much upside to the global economy in 2024. With a bit of a soft landing projected for the US. India is one shining exception, but after that, China, of course, lots of uncertainty, and these are the big marginal importers. Europe also forecast to remain rather flat. So does that sort of, map with your view of oil demand?
Yeah, so Timur, the global economic prospects that you are zeroing in on is exactly what is shaping the outlook for the global oil market as well. So for oil, there's a pretty direct connection. Of course, there's plenty of dots in between that need to be connected, but nonetheless, a connection definitely between the health of the global economy and the health of global oil demand and oil demand growth. So we are now contemplating a second year of global economic deceleration, right? And then we have within that you tend to look at, okay, what's going to happen most likely in the US in terms of economic momentum, what's happening in OECD Europe, and what's happening in China. So just for the sake of sort of simplification, so when we talk about global economy and global oil demand, you then, as a next step, the oil market participants tend to zero in on these three regions. And so you look at the US economy, okay, perhaps a soft landing. I think a lot depends on what the Fed does with the interest rate, whether it cuts or not, and so on. Eurozone, or let's say OECD Europe, not in as good a position as the US. We saw an ECB official saying in Davos on the sidelines yesterday, for instance, that do not bet on interest rate cuts. Because I think it appears that inflation is a far bigger problem, more stubborn in Europe. And then you come to China, and we'll talk a little more about that separately. But for a moment, let's just take these three regions together, right? If you look at the US, Western Europe, and Chinese oil consumption, the three of them together account for 50% of global oil demand. So that gives you, so the remaining 50%, this is the other important attribute to keep in mind. The remaining 50% is distributed amongst much, much, much smaller consumers. And the reason it's important to keep that in mind is that even if some of those consumers, India, for instance, are going to see a strong economic growth, a strong oil demand growth, none of them are going to be the engines of global oil demand growth, like, let's say, the China was in the 90s and the early 2000s, right? So just look at China and India, for instance, the second and the third largest oil consumer, and what a big gap between their consumption. So China consumes a little over 15 million barrels per day. India consumes 5 million barrels per day. And if you were to line up the next 7 major consumers and the next 10 consumers of oil, you'll find that oil consumption globally is split into much smaller consumers. So basically that gives you a smaller base of growth. So this is what, so when the oil market participants contemplate 2024, they're looking at, okay, economy softening, most likely oil demand growth in China. So growth, it will grow, but the growth itself is softening. We estimate Chinese oil demand grew by like about 900,000 barrels per day year on year last year. This year, perhaps about 500,000 barrels per day. Western Europe and US actually present an interesting contrast. So both these countries, not just by virtue of their economies, but mature economies, but also by virtue of demographics, are actually well past their peak oil demand. And that's very, very clear in the data that we have in front of us. So if for the whole world and a lot of the countries, we tend to talk about, okay, so where is this country's or the global oil demand today or in 2023 versus where it was in 2019, right? We tend to go with so has the COVID demand destruction been made up for? So yes, on a global level, it has. So in 2023, global oil demand for the first time climbed above 2019 demand. So, but if you look at US and Western Europe, together, the two regions are about 1.6 million barrels per day lower in terms of oil consumption than when they were in 2019. And the path forward for them is probably between flat stagnation in a best case economic growth scenario to perhaps a continuing downward decline if the economies are struggling to grow.
Fascinating. It sort of tells you that some offsets here and there, but those three chunks are the key determining factors as far as the energy market is concerned. But we want to talk a little bit about the medium-term outlook, and you've in fact started touching on this, but I want to talk specifically with respect to OPEC. In the last year, we've seen OPEC try super hard to rein in on oil production, and even though the U.S. government has been putting pressure on the Saudis and others to keep the global oil market well supplied, I think they only had limited success. Maybe the softening demand aspect that you've been talking about played a more pivotal role in stabilizing oil prices than the U.S. pressure on OPEC. So, what is the medium-term outlook for OPEC? Does it survive the way it is?
That's $1 million question. So OPEC plus the market perspective expectations of OPEC plus, I would say, have undergone quite a dramatic shift. I would say from around the second half of last year. So the received wisdom through much of last year was that OPEC plus was in control, in command. It was quite cohesive under the leadership of Saudi Arabia, or sort of joint leadership of Russia and Saudi Arabia, the two biggest producers within that alliance. It was quite determined and capable of putting a floor under prices, if that's what it needed to do, if there was downward pressure. And for much of last year, actually, that was borne out. So we saw OPEC Plus coming together last April, announcing cuts from May. And they managed to sort of avert a slide in prices, especially during the times when economic fears were starting to swirl around in the markets. What has changed, I would say, towards the latter half of last year is that some things, some tensions, some problems within that alliance, within its ideology, its strategy have come to the surface. A major one of which is that when it instituted cuts starting last May, it made a major departure from convention. So the convention for OPEC Plus, since it came together as this alliance, and before that for OPEC, has been to set an overall target for the whole alliance. And then that if, let's say, the target is being increased or it's being pared back, then that amount is equitably distributed between all the members. And then everything is transparent, which, as we both know, is very, very important for markets. If you're trying to send a strong signal to the markets need to see the numbers, right? So then they would publish that this is our overall target, this is the individual members' quotas, and then they would have regular meetings to assess how they were doing against those targets. The members that were, let's say, not complying would get a sort of a rap on the knuckle that, please fall in line, and so on. The departure last year was that they did away with this convention, and so there's out of the 22 members until the end of last December, now there's 21 because Angola has quit. But of the 22 members, 19 members were participating in these pacts, right? But of those, only 9 members came up with what was called voluntary cuts. They were not announced the usual way with a full ministerial meeting and everything then officially published. But each country made an announcement saying we are doing these voluntary cuts. Now, such voluntary cuts are not unheard of, but usually they have been used by Saudi Arabia and as an ad hoc mechanism, sort of like a stopgap arrangement, if you will. But as it turned out, last November, I feel they were probably trying to get back to their track, to their conventional way, but a lot of tensions cropped up and they couldn't. And so now we have the situation in which these 9 members have come up with voluntary cuts. The other 10 peers are not cutting output. There's quite a bit of skepticism in the market. There's a lot of doubts in the market as to whether, these being voluntary cuts, to what extent the countries will abide by them, whether they will be, whether a discipline will be enforced, and so on. Background of all of this, sort of an old theme in the market, but has cropped up all over again, is also speculation that perhaps OPEC Plus is just some sort of a fatigue, and it's probably maybe the beginning of the end of its market management policy. So all of this is casting a huge shadow, and if you look at last year, pretty much it was OPEC plus being disciplined, cutting back output, and then the Saudi energy minister, every now and then sort of warning speculators not to short oil, and all of that came together to hold a sort of a floor under prices. Let's call it $80. That was the market expectation, that's where OPEC was trying to put a floor. But all of that has now disappeared. So the market doesn't have the confidence now or the expectation that OPEC Plus will be able to continue cutting even deeper if need be. So just to take a quick example from what's happening right now. So last November, they decided that they will cut an additional 900,000 barrels per day, but they announced that just for the current quarter. What's going to happen after this quarter, has been sort of is up in the air, or has been, left for the market to guess. So that's also all adding. Basically, it's become what in the market is traditionally called an OPEC put, right? Like no matter what, OPEC will do something to put a floor under prices, to prevent prices from entering a downward spiral. That OPEC put has disappeared from the market.
Indeed. Okay. The other big player, of course, in the oil market, and which has also seen game-changing developments over the past decade, is the US. Some comments on the future of the shale industry in the US.
Yeah, so I think one should start with the sort of phenomenal and highly unexpected spurt in growth that we saw in the US last year in 2023. The US production grew by about 1.1 million barrels per day to a new all-time high of about 12.9 million barrels per day. Now, it was unexpected because if you look at all the other data and evidence that you have in the shale sector. So for instance, what the shale producers, for instance, what their executives are saying, signaling to the market when they come out with their quarterly results. You look at what's happening to rig counts, to fracturing fleets, and so on. And the sort of unchanging theme there has been that they are funneling more and more of their profits into paying off debt, into rewarding shareholders, so doing share buybacks, distributing good dividends, and not so much of their profit into growing production. A lot of, yes, capex did go up last year, but a lot of that was also taken up by higher costs. So, inflation affected everything from manpower to rig costs to the materials used in the shale sector and so on. Now, that story hasn't changed, remains the same in 2024. There's a lot of consolidation that's also happening in the shale sector. We saw that with mega mergers at the end of last year, mega big purchases by ExxonMobil and Chevron. The consolidation story will continue. That is another reason we expect production to be sort of continued in a moderate growth phase, but not in sort of, we don't expect companies to be prioritizing growth. So 2024, currently the expectations are maybe it will continue to grow into yet another new high, but perhaps by a much less amount than last year, perhaps about 400,000 to 500,000 barrels per day.
Okay. And US, especially with the Inflation Reduction Act, has really turbocharged its green transition process. Europe is coming up with regular new regulations on border adjustment tax and targets for greening their economy. China is, again, going on all cylinders in embracing EVs and green energy and so on. So, Vandana, maybe we conclude on that key issue, that how does demand for conventional energy look with green transition in mind?
Yes, so it's a key transition that is enveloping the energy markets across the globe. I think what doesn't help is that, of course, it's a highly emotive issue. It's highly politicized. In recent years, we've seen this major tension crop up between the so-called global South and the global North. We saw that kind of in play at COP28 late last year. But let me sort of summarize it in this way. So this shift away from fossil fuels and certainly coal, oil and gas, I would say to a much smaller and slower extent, but the shift is happening. It's just not, I don't see it happening at the speed as what some of the most optimistic projections out there have portrayed. For the simple reason that, energy is like so crucial, underpinning our lives, our lifestyles, our economies, our very existence, that it's just not, it's hard to fathom how we could simply jettison oil and gas, and for that matter, coal, before we have alternatives that are available on the same scale and are affordable and accessible. So we see, that between this debate between the global South and the global North, part of that is also the emphasis on energy security, affordability, accessibility. We know here in Asia that's key for policymakers. So all of that, combined with the fact that at the same time there is an acknowledgement and a realization that we do have to continue reducing our emissions, but there's now this. I think an acceptance that it has to be a balancing act. So within that context, I see, it's very clear. You have a lot of anecdotal evidence, which often makes its way into the headlines and sways perception as opposed to the ground reality. So yes, renewables are growing. Yes, electrification in terms of mobility is growing, but they're all growing from a small base. So I think we need to wait to see them have the sort of impact where we can talk about, okay, we can now start reducing our oil and gas consumption. So there's electrification, of course, happening at much faster pace in some countries than others. Greener alternatives, and I wouldn't mix the two, because let's again keep in mind that electrification in countries like China, right, the fastest pace of electrification, more than 60% of the electricity is coming from coal. So it's not necessarily a greener alternative, but nonetheless, I think it is something that will eat up slowly into the share of gasoline and diesel, right? So then we have greener alternatives. So renewables, definitely. And then we have nuclear energy, and we have biofuels. So all of these also growing from a small base at double-digit growth rates, some of them, no doubt, but from a small base nonetheless. I think energy efficiency is also something that doesn't get much talked about, but that is also making its own contribution. But also this will be a slow burn, right? You won't see it making a sizable dent in oil and gas demand anytime soon. And at the end of the day, it's simply demographics. So as you discussed at the start of this podcast, what we are seeing happen in US and Europe, which are mature economies, but also mature societies and graying societies, if you will. Well, China is also going down the same path. What might have been unthinkable in the last decade now is that Chinese analysts themselves, analysts at the state-owned Chinese oil companies, are talking about peak demand in China within this decade. Some of them say even in the next 2 or 3 years. So I don't think that's out of the question. In which case, again, then you're left with the question: so where is the next demand growth going to come from? But globally, I can see that perhaps by the end of this decade, as a result of all of these shifts, we're probably going to see on a global level peak demand, perhaps sometime by the end of this decade.
Well, I'm personally really compelled by the efficiency argument. And to that point, last year, car of the year in the US was not an EV, but a hybrid, Toyota Prius. And the Japanese car manufacturers in particularly are making the point that looking for a middle solution where we don't completely forsake oil and gas, but at the same time try to improve emission might be the interim solution we need before we actually have the charging infrastructure and the clean electricity that would only make sense, that entire transition. Without that, it'll be a half-baked cookie. Vandana, fantastic. Great tour of the world, both near-term and short-term. Thank you very, very much for your time and insights.
It was my pleasure. Thank you for having me.
Well, great to have you, Vandana. And until next time, thanks to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge from Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. All 115 episodes of this podcast series are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publication, you can find them all by Googling DBS Research Library. Have a great day.